All right, welcome to another Bitcoin Intelligence Report, Monetary Mechanics. And this image shows everything. So basically now, after the lousy data coming from the labor section of the US economy, let's forget about inflation, shall we? So it doesn't really matter anymore. We don't have a specific target, even though that was important in the first place. So this is a very interesting, and a whole shift is expected to happen by the Fed. So let's talk about what actually happens with liquidity once this process gets to motion. So first off, the labor data, the most important one would be the fact that the number of unemployed workers now is higher than the actual job openings, and that happened for the first time since 2021. So we do have officially a weak labor market, and now it's all about the labor. So when you normally see those cycles, that's why we call the Fed as too late Fed. So that's where Trump would be actually right, regardless of your opinion about him, because that's actually how it works. So the Fed, by definition, looks backwards, doesn't look forward. And every time it happens, it's already too late because labor data, especially unemployment, it looks like it's pretty stable for 5 to 7 months, and all of a sudden you have a spike. So when everybody's talking about it, that's where the Fed actually cuts. But we should not be truly surprised by that because the yield curve tells us that already. So if you see here, this is a comparison, that's an interesting comparison of the shift of the yield curve from August to September. So pretty short term. So we have August 14, which is the top, September 2nd, which is the middle one, the red, and September 5th, which is the blue one. So you see how that shift downwards is still keeping the same kind of shape as the Nike logo a little bit, maybe a way for them to tell Jerome Powell, just do it, right? Just cut it. And you see how so all of the maturity, so from 1 month up to the 30-year, everything is going down. So this breaks the narrative that nobody wants U.S. bonds anymore, or there is no reason to buy bonds. It's a hot potato. Nobody wants it. So yet another way to debunk that. But what's mostly interesting is if you see this U shape at the beginning on the left side, that means that the market already knows that the Fed will eventually cut and will have to, even though they don't want to. They will have to, because the only thing that is holding the very short end of the curve together is the Fed funds rate, which is not part of it, right? So it would be on the left of the left, so to speak, outside of this chart. That's where everybody discusses. I hope TradingView is able to include that in the next one, so we see the effect or the magnetism of the Fed funds rate to the very short term. But once they start cutting, then we're going to see a little bit of a flattening because it takes the 1 month, the 3 month, and so on with that. However, you don't see that happening on the 2-year yield. It's under 4% for a long time. It's actually 3.6. So that's pretty low. That's what nobody talks about. It's pretty interesting to see. Everybody talks about the volatility of the 30-year yield, forgetting that the actual reason is all about a bull steepening. So you see that this curve is telling us that the market expects lower growth and inflation expectations, and also looking towards safety and liquidity. This is why there's such a high demand for the 2-year and the 5-year. And again, interest rates are inversely correlated to the price. So the higher the price, the lower the rate. And this creates a whole poly-market theme. So betting is, so the betting market over $73 million is showing that it's almost a given that we're going to have a 25 basis point decrease, so a cut. Some are, so 50 basis points is getting on the table now by 11%. it's all about the optics now, right? So if we cut 50, we might seem desperate. We might seem somebody who admits that we haven't listened to Trump and we should have cut a long time ago. 25 basis points is currently my base case if it was to bet here. Of course, this is no investment advice, no gambling advice either, but the 25 basis point would be my base case for now, just to show that, look, we're doing what you want us to. If that's what you're pricing, that's what we will do. But everybody knows this doesn't help absolutely anything. This is basically optics, and rate cuts don't even help any. It's completely useless, right? In what comes to generate liquidity. We already have the liquidity. So it's all about expectations and short-term trades. And we do see that volatility that was created based on those lousy job numbers on the 10-year yield, which is pretty important as a reference for the for the mortgage rates. Yeah, I forgot the name. So for the mortgage rates. And we do see a huge decline. So, what about the safe haven? So, if nobody wants T bills or bonds anymore, T notes, and everything related to U.S. debt, could you explain that? So that's pretty interesting. But it also creates some volatility. So this is basically the market saying that they expect lower growth and inflation expectations. So this is what the yield curve actually tells us, especially on the long end of the curve, but also on the 10-year yield. But this here, since the volatility increases now based on this, let's see what happens. This is a little bit liquidity negative because in September, we have something that we call September effect, which is a pretty interesting but mysterious effect that provides normally volatility to the upside on the yields, and this is already expected by people. It's something that is seasonal, but because nobody knows the reason, everybody prepares for it, and that perpetuates the whole thing, like traffic on a highway. So the accident is long gone, but everybody still stops. So this is a little bit of the September effect that also helps drive the volatility. But if that increase is actually liquidity negative, because the more volatile prices of bonds are, even if they're going downwards, this creates a little bit more of uncertainty for you to leverage on it. So this is a little bit of liquidity negative, but not too much in my honest opinion. And we're still tracking the TJ refills, so how the accounts at the government are being refilled at this time, and it's still up and up and up. So the goal, the target would be 850 billion. We are at 661 billion. And in my opinion, it has nothing to do with the volatility that we are seeing, because we already had that kind of pace before it actually happened in September. And based on the fact that mostly the choice by Scott Bessent to refill this account is the issuance of short-term debt, which is also very well used as collateral by the market, which provides liquidity. That's a great way to compensate for the liquidity that you drain to this account that would eventually bring Bitcoin prices down, or the stock market and so on. So he's if the goal is to make it as fast as possible and as smooth as possible, I would say that Scott Bessent is having an A+ right now on that task. So, and talking about Scott Bessent, also one of the things that helps drive a lot of that TGA refill is increasingly being tariff revenues. So regardless about your opinions about that, of our opinion about that, it's happening, and we do have revenues that are constantly growing. So August has been an interesting month as well, over $30 billion in tariffs. So that goes straight to the TJ because it's basically a tax. Okay. So, and without the need of issuing new T-bills for that matter. And the if you remember on the BI report where we discussed about Scott Bessent actually sculpting the yield curve, where let me go back to the yield curve so it makes more sense to you. So let me come back here. So basically the idea is if we see that on the left side we have too much demand, we have a lot of demand, we're going to focus on that, right? We're going to issue more and more of those short-term T-bills. But on the other hand, we're not too interested on the long end of the curve, not completely ignoring it, but not too interested either. And the idea is to control that. So a little bit of a yield curve control, stealthy yield curve control without announcing anything. But you do what we call a buyback. So you buy a little bit of the long end of the curve. So what we call off the run. So when it's been issued for a long time and it's not really used as collateral, it's just sitting there, you can just buy it back and reissue an actual T-bill on a short end of the curve to compensate for that. So it's a clever way for you to sculpt that curve and make sure you have more collateral, but you still serve the debt of the United States. And that's exactly what they have been doing. And I believe this will increase over time. So they're not doing too much right now. So it's been in increments of 2 billion here, 2 billion there. So 6 billion in a week. So let's see how that goes. But it's still being constantly done, and we expect higher volumes over time as well. Now, interesting developments in China. So it's basically the same as we discussed last time, but the geopolitics is really what we have to look out for, because we're seeing a complete revolution on the monetary system, where we're seeing ruptures happening, especially for people who are not to be considered allies anymore. But the problem is we need to understand the movements that are happening to know which are going to be the new allies or the new enemies. And the fear that the U.S. may use treasuries in order to actually weaponize them against their enemies is something that drives many of these countries like China, India, and also Russia to gold. And Trump actually recognizes that, right? Based on this tweet, for example. May have a long and prosperous future together. So looks like we lost India. We actually had already a trade, not a trade deal, but they have had a previous friendly visit, but things changed a lot. Now they don't really talk, and that's how you start to fear that most people are just going to try to get rid of treasuries. But as you see, more and more money is buying those at the same time. So this is a whole situation, and shows how it's so difficult to get rid of the Eurodollar system, especially based on the fact that all of these countries have debts denominated in US dollars to pay. And this is the biggest problem. You cannot just abandon the dollar and start using something else. That needs to be served, and it's not against the United States, but against each other. That's the main problem, because one liability is another's asset. Who's want to give up their assets? So that's basically the problem of leverage, and how the whole Eurodollar system grew on that premise. So and of course Trump knows that. That's the kind of card. So when he says something like that, if I played my cards, I could destroy China, but I won't. Basically, he's letting them play. I'm not saying that he has a master plan. He's a very intelligent guy, so it's up to you. The thing is, he knows how China is actually dependent, and everybody else is dependent on that system, which the United States do not have full control, but they have the most control, and that's what matters. It's really a relative game, as it would be well said by Brent Johnson from Santiago Capital, who I follow a lot on that matter as well. So basically, you have the energy game to play, so you can cut oil distribution to China. It's one of the weaknesses as well, even though they are catching up a lot in energy production. and they have a lot of reserves, so they know about that. Also, you can cut them out of the monetary system, right? So you have many ways to create problems that could really jeopardize China if things escalate. And this includes the whole monetary system. And this also provides a way for you to understand what could happen to liquidity. Not the case right now, but things could always escalate. And it has to be part of your macro analysis to Bitcoin. It doesn't matter, because Bitcoin is subject to liquidity, and this is what liquidity is subject to. All right. So I hope it was helpful. But just so you know, the same outlook that we had last week for our indexes like the S&P 500. Let me just put it over here while we're still there. So let me share this one. So for the S&P, we are still bullish. So we still see that the resulting force would be something more still related as a liquidity positive event, even though we have weaker labor numbers and it went down. I would take care of the response of how the administration does not want it to happen under their watch. So Trump wants his face to be on Mount Rushmore as the best president ever, regardless of our opinions. So we're still bullish on that longer term. Also, DXY, we're watching, as we said before, so we're watching this a possible reversal since July. So it is getting stronger, but our outlook is still bearish based on this time here of the trend of several months. And also Bitcoin, for sure, it's a little bit of the same. Not too much as just an S&P, but it had the component that is taking from gold as a commodity-like reserve is increasing, in our opinion. So this shows a little bit how it, for sure, I would expect some volatility. This is very welcome, in my opinion. This is something that, as we said, you can always take advantage of, but we're still with the bullish outlook for Bitcoin as well. All right. So hope it was helpful, and see you next week on our next video.